When you think about the biggest companies in the world, the ones with those huge market caps, what comes to mind?
Usually tech, right? Apple, Microsoft.
Exactly. The tech giants. They seem to dominate everything. But get this. A financial company just hit a $1 trillion valuation.
A financial company.
Yeah, the first non-technology company ever to reach that. It kind of changes the picture, doesn't it?
It really does. Shifts the perspective on who the big players are.
Welcome to the deep dive. Today, we're really going to dig into the heavy hitters in finance.
Cutting through the noise.
That's right. We want to figure out which financial stocks are not just massive, but which ones an expert analyst sees as, quote, excellent long-term investments right now.
Giving you that shortcut, the key insights.
Exactly. So you can be well-informed about these major players, see the surprising facts, and what they actually mean.
Okay, let's do it.
So let's unpack this. It's easy to think mega caps are all tech.
That's the common view, yeah.
But the scale to some financial firms is, well, genuinely surprising. It's not just the one that broke $1 trillion either.
Ah.
No, the largest U.S. bank. It could potentially join that club in a few years if things keep going well.
Wow. That's fascinating how this supposedly traditional sector keeps producing these giants. So as of, let's see, August 12, 2025.
Yeah. Who's on top?
The top 5 U.S. financial stocks by market cap are number 1, Berkshire Hathaway.
Okay.
Then JPMorgan Chase, Visa, Mastercard, and Bank of America rounding it out.
Quite a list. Powerful names.
Definitely.
Now, Berkshire Hathaway at number 1. I think a lot of people, like you said, don't really think of it as just financial.
Right, because it's all the other stuff they own.
Yeah, energy, railroads, that huge stock portfolio with lots of tech in it. So help our listener understand, what makes Berkshire fundamentally financial?
Yeah, that's a really common point of confusion. But, its core, the absolute foundation, is insurance.
Insurance, like Geico.
Exactly. Geico, plus several big reinsurance companies. Those are the ones that insure other insurers.
Okay.
And that insurance business generates something called float. It's the premiums they collect upfront that they can invest before paying out claims.
So that's the engine.
That's the engine. It let them build up that, $300 billion stock portfolio and buy over 60 other businesses outright.
Incredible.
And that's what recently pushed them over the $1 trillion market cap mark, the first non-tech company to do it. Undisputed, largest in finance.
Okay, so here's where it gets really interesting for investors listening. You mentioned it might actually be a bargain right now.
Yeah.
A $1 trillion company.
Well, yeah, it sounds counterintuitive, right? But the stock's actually down about 12% in just the last 3 months or so.
Why the drop?
It mostly followed the news that Warren Buffett announced he plans to retire.
Ah, the Buffett effect. Or lack thereof, maybe.
Sort of, but here's the thing. While the stock dipped, their massive stock portfolio, it actually became more valuable during that same time.
Oh, interesting. So the underlying assets grew.
Exactly. And if you back out their huge cash pile, like $344 billion in cash,
Wow.
and the value of the stocks, the actual operating businesses, they're trading for just over 11 times the last year's operating earnings.
Which is cheap.
Generally considered pretty cheap, yeah.
Yeah.
Especially in this market. Now, look, there's uncertainty with Buffett stepping back, sure. And some people are frustrated they're sitting on so much cash.
Understandable.
But for a long-term view, it still looks really solid. The market might be focusing too much on the transition, maybe overlooking that underlying value.
Fascinating. Okay, so that's Berkshire. Let's pivot a bit to the banks on that list. You said there's a case for any of them, but are some more attractive buys right now.
Absolutely. Right now, Bank of America really stands out among the big banks.
Why BOFA?
Their second quarter was just really strong, earnings up 7% year over year.
Nice growth.
Yeah, and get this. Customer deposits actually increased by 5%. That's impressive when things feel a bit uncertain for consumers.
Good point. People are trusting them with their money.
Seems like it. Plus, their investment banking side did well. And looking ahead, Bank of America could really benefit when interest rates start coming down.
How so?
Lower rates generally mean lower funding costs for banks and potentially better margins on their loans. BOFA is well positioned for that shift.
Okay, so Bank of America looks good with its scale and performance.
Yeah.
Any other banks catching your eye, maybe for different reasons?
Yeah, Wells Fargo. It presents a different kind of opportunity.
Wells Fargo. How's that?
Well, for one, it's the most consumer-focused bank on that top list. Meaning it could be the biggest winner from falling interest rates.
Yeah.
Because its interest expenses should drop quite a bit.
Okay, more direct benefit maybe.
Potentially, yeah. But here's the really big news for Wells Fargo, the transformative part. Remember that asset cap they had?
Vaguely, yeah. From the fake account scandal years ago.
Exactly. It was a regulatory punishment, basically capped how big their balance sheet could get. Limited growth, lending, everything.
Right.
Well, that cap, it's finally been lifted after all these years.
Oh, that must be huge for them. Like taking off a straitjacket, you said.
Pretty much. It genuinely unleashes them to grow again in ways they couldn't before. It's a major catalyst.
Okay, that is significant.
And, thinking broader, both Bank of America and Wells Fargo might benefit from the current political environment, too.
How so? Just reporting what the source material suggests here.
Right, purely observation from the analysis. There's a view that a potential Trump administration might bring a, let's say, generally looser regulatory focus.
Okay.
And specifically, if that 15% corporate tax rate he campaigned on actually happens, well, big banks usually pay effective rates in the 20s.
So that would be a significant boost to their bottom line.
A potentially significant boon, yes, just based on the numbers.
Okay, so compelling cases for Berkshire, Bank of America, and Wells Fargo. What about the others on the list? JPMorgan Chase, Visa, Mastercard, are they just not the play right now?
Oh, definitely not saying they aren't great companies. They absolutely are. JPMorgan Chase. It's a powerhouse. Incredibly well-run, diversified,
Right.
but it trades at a pretty wide valuation premium compared to BofA and Wells Fargo right now.
Meaning it's more expensive, relatively speaking.
Exactly. Makes it less attractive from a pure valuation standpoint today.
Got it. And Visa and Mastercard.
I mean, they're basically a duopoly, right? They dominate this massive, essential payments market. Their networks are everywhere, super resilient, benefiting from that whole shift to digital.
Sounds pretty good.
It is good. But the question is, does their future growth potential really justify how much you have to pay for the stock right now?
The valuation question again?
Yeah. Visa's trading at, 33 times earnings? MasterCard's at 39. Those are high PE ratios.
Pretty steep.
Very steep. It suggests the market is already pricing in a lot of future growth. Maybe too much.
No.
It's harder to see the bargain there compared to the others we discussed.
Okay, that makes sense. So just to recap for you listening, the three financial stocks that seem to stand out right now as particularly attractive, based on this analysis, are Berkshire Hathaway.
For that value hidden by the transition noise.
Right. Then Bank of America.
Strong performance, poised for falling rates.
And Wells Fargo.
Big consumer focus, potential rate benefits, and crucially, that asset cap is finally gone. Plus the potential regulatory tailwinds for both banks.
Driven by attractive valuations and these specific future opportunities.
Exactly. And just for full disclosure, the analyst whose work we're drawing on notes that Berkshire and Bank of America are actually among the 10 largest positions in their own portfolio.
Oh, okay. Skin in the game.
Seems so.
Okay.
And they added that Wells Fargo is very high on their personal watch list, especially thinking about potential rate cuts ahead.
Right. Well, there you have it. Hopefully that gives you a clear roadmap for understanding some of these financial giants, cutting through the chatter to get to the insights that matter.
Yeah, seeing how a non-tech player hit $1 trillion, the nuances around rates, regulations, it's complex but important.
Absolutely. So as you think about this evolving landscape, with these giants redefining what's possible in finance, here's a final thought. How might our traditional idea of financial stability continue to change in the coming years? And what could that mean for investment strategies, not just now, but looking further down the road? Something to chew on.